This is eSec Money and Insights. Let's get over to our episode.
We're going video on, Mark. Did you know that?
We may do video on, Mark.
This genius just sprung that on me 3 minutes ago as she's putting on lip stuff. We're doing video for the very first time. 100 and something episode. Didn't want to give you a heads up, but she had a heads up. Right?
Well, it could be.
Well, if it's her ideas, yeah.
It could be this time. It could be next time. I like to fly by the seat of my pants.
Mm-hmm. Yeah. How are you doing today, Brooke?
Oh, wow. You're going to start with me, huh? Well, how much time do we have? Can you settle in?
Cliff Notes version on how you're doing today, Brooke.
The sun is shining, so I have to at least be happy about that. Life is a lot these days. I've been sort of all over the place, and I'm going to be all over the place in the weeks coming up. So I'm not trying to stress about my travel, but there's a lot going on right now. But things are good.
Yeah. Same here. We're busy on the desk. A lot going on ahead of quarter end. Mark seems to be either faking being busy or is actually busy. I'm not sure which.
This isn't for the cameras. If I got that heads up or not, would have been doing the same thing.
So talk to me about quarter end. Should we start there?
It's a good spot.
Mark, I know we don't have Mike Brooks. He is otherwise occupied at this moment. I think he's in a meeting with a dealer, and he would talk to us quite a bit about quarter end, but you have the same funding trades and funding pressures, maybe felt in a different way through the trades that you're supporting. How are things upcoming for September quarter end?
Sure. Yeah. Sheet's tight. We're hearing of bottlenecks with some of the US GSIBs. I think what has been most helpful has just been proactive communication and working through it with some of our partners and our clients. I think just being careful with how you allocate balance and where you put it. In the past, we've talked about funding wrappers and the importance of those and making balances resilient and other ways that could be street friendly when it comes to GC. I think all those concepts are more acute around reporting dates. A lot of that work you might do in the middle of summer when people are less focused on sheet and things like that. And sometimes you don't wonder about the benefits of it, but you don't immediately realize them. And then when you get closer to reporting dates, you can see the importance of having those street friendly structures in place. And there's some dealers are asked to do more of them, ASAP, it seems like. I think we're going to turn the page on quarter end and then immediately look at year end. So that will definitely be in focus throughout Q4.
This quarter end feels like the focus on balance sheet by our top 5, top 10 borrowers seems more acute now than it has in a long time versus RWA or any of their other GSIB requirements. It just seems like shifting stuff off sheet quickly. It just came on out of the last couple of weeks. Wouldn't you agree, Mark? Seems a little bit more widespread and important to folks versus normal times.
Yeah, definitely. I think it's one of those things where it kind of seems like it's almost a good problem to have. Equity trading numbers have been fantastic this year. So there's been a lot of positive results that we hear about on the quarterly earnings calls. I think US GSIBs and PBs in general have had a really good year. Markets are up, particularly since Liberation Day. They've seen strong inflows from clients. I think it's one of those things where having a sheet problem is just a symptom of having a great year. It's everyone's job to manage that to the sense that it's their problem, it's my problem too. That's what's happening, Jim. That's my perspective from the outside looking in. We've had a couple of industry type calls with borrowers too. I think that's more or less what they've communicated regarding sheet.
Do you think it would be the case regardless of the Fed stress test timeframe they do on the banks this time of year? Or do you think that it's a compounding factor?
My take would be it has little to do with that, the stress testing. That might not be the same time of year for every bank. It may be different time periods they're going through. I think it might be more of an edict from regulators saying, hey, sheet needs to be a little bit cleaner than this across the board. Anytime you see our borrowers or the counterparty community move in tandem like that, it just feels like something bigger is pushing it. Otherwise, it just doesn't make a lot of sense. It feels to me a little like there was this big push to move from cash to equity. We all scrambled to onboard non-US banks, the UK entities for these guys to do E for E. It was an easy way to pick up market share and balance if you were there first or among the first to do E for E. Now the push is in the US to do treasuries as non-cash. I don't think it's everything
rather than cash.
It's a minor shift, not a major shift, but there's definitely fall cleaning happening on the sheets. And it may not last. Things move in and out of favor quickly now. I haven't had conversations with brokers. Maybe you have, Mark, regards to after the turn. I suspect it turns quickly to RWA management away from balance sheet once the year's over. We'll see. Either way, I think activity in general across the globe has picked up. We've seen it in Asia. Hong Kong's been brisk for us. Taiwan continues to be strong. Even in Europe, in some of these GC markets, the developed markets, there's way more flow happening. It's from 1 to 2 and not from 10 to 20, but it's moving in the right direction. And here in the US, IPOs are pretty active. They keep coming to the
Right.
market, and we're flowing through some of the expirations. So they're getting hard to borrow for a month or two. So that continues. M&A are getting announced. We wake up every morning to new announcements. Many of them don't have a lot of immediate value for securities lending and extracting value that way, but a lot of them have promise in the future. So feels pretty good. Pretty much everybody we talk to is expecting a very active end of the year. People can shut things down and just protect gains, which would make total sense this year. Do that in mid-November and see in
Yeah.
January, but nobody's expecting that yet.
Hmm.
As Mark was pointing out, it's been a good year for many strategies, certainly a good year for long US.
Mark, Jim just noted there's been a bunch of IPOs. He noted deals continue to be frothy. Maybe it's not resulting in immediate trades, but there's promise of that. You always follow the US equity market rates closely. What's that cycle look like in the last couple of months versus where we were a month or two ago earlier this year or historically?
Yeah, sure. Good question. We started the year with a pretty cool market. There wasn't a lot of IPO activity at all because we had Trump's elected, we had the rally. Then after the inauguration, we kind of got into speculation about rates and tariffs, right? So we have this pent-up demand for IPOs and deals that we see coming to market now. Paramount was a big one this summer. Average fees were relatively low through Q1, really picked up post Liberation Day. So yeah, the market volatility, the typical seasonality that comes in Q2 with the Russell reval, then CoreWeave. One borrower told us that CoreWeave was so painful, it was challenging for them to make money because rates were so high and it was challenging to pass those spreads onto their clients. Not a problem on this side of the trade necessarily, but we saw that bear out an average fee, right? So we had three major events that moved us from an average of 40, 50 basis points on loan for US equities up to 100 to 110, which is really where we've kind of maxed out the last couple of years. There seems to be always something that drives us up to that area. We had AMC GameStop in the summer 2 years ago. I think it was 2 years ago now, right after Russ reval. Then last year we had Siri right after Russ reval. And then this year we had CoreWeave and Paramount was a standalone trade that was captured in a day. But we've kind of always have had the reval and then like another name or two that kind of moved everything. It's always the tail wagging the dog. So I think for the top 50 US equity specials, half the value of those top 50 was with CoreWeave. So we got pretty white hot, and now we're back to that 50, 60 basis point range, which is more normalized, I guess. Last year, we got to this number right after the Siri trade closed in early September, and then we cruised at these levels into year end. It's a good market. There's a lot of breadth. We're seeing a widening of breadth in the cash market. Russell's had a good couple of weeks here. So with lower interest rates can come new long short cases. From a lender perspective, this market could be well positioned for us to see a widening of the trade a bit with a new paradigm.
Corporate bonds. I know we've done a handful of auctions recently over the last couple of months. How has that space been? I know that a while ago, the theme would have been you can't have enough good corporate bond supply, a lot of demand for that sector. How has that maybe changed, or is that still thematically the same?
I'll let Mark talk to the discretionary trading of corporate bonds, but I will say that the auction market is telling us it's still very important to the brokerage community. Captive supply. We still continue to see more bidders every auction with high yield assets specifically. I think that will continue. It looks like there's growth on many desks on the street in terms of both personnel and onboarding of credit strategies. Seems important to everybody in the chain. I don't know if you look at this, Brooke, but I have the sense our client base is generally buying IG and high yield bonds versus selling them just across the board. If you looked at our total lendable in those spaces, it's up. So seems to be something important that's going to be here to stay for a long time. It's a big piece of our clients' revenue in North America from
Right.
lending is corporate bonds, specifically high yield and emerging market debt. So that's a trend that continues and will continue, in my opinion. I would guess discretionary shows similar trends. Mark Mack.
Yeah, definitely. It's been a pretty well utilized product for a bit here. I think to your point, there's more focus on credit strategies in general. High yield was always kind of a low-hanging fruit and was an obvious place for there to be borrows. There's good shorts in high yield, but we're seeing a ton of pickup in the IG space. There's a lot of churn in those books. So I think, for borrowers that have access to stable or passive supply or really scalable supply, because some supply might have a good breadth of names, but it could just be smaller. So it's tougher to scale into a position. So I think if you have a portfolio of scale, you can position it well to drive alpha for beneficial owners.
We need
What
to
have
start
you?
thinking about year-end predictions, don't we, Brooke?
Oh, well, you're talking my language.
Year-end predict what's
Okay.
next for the market. We should think about that.
I feel like we have a flurry of podcasts that I want to do in the next couple of weeks, with other industry and market participants, some of which might be returning friends, and others, if we can get some new folks and new names on the podcast, that'd be fun too. I will highlight, listeners, that someone in the market apparently reached out to Jim referencing something from one of our recent podcasts. And Jim had zero memory or recollection of the conversation. I'm like, of course, that's what we discussed. He's like, I don't remember that at all. We think Jim might black out after we podcast every time.
What are you hearing from clients, Brooke? What's important on the lender side these days? What's the common theme?
Yeah, I mean, a
Themes?
lot of our clients, not all, because there's different types and reasons why people are active in their participation, but a lot of our clients are very focused on funding and driving cash from lending or repo, essentially driving cash for funding and leverage and thinking about their overall liquidity for their plans and how best to integrate lending and the ability to raise cash. Is that a more stable source? Is it a more efficient, cost-effective source? And what do they need to do to improve the stability and the cost effectiveness of funding, leverage, or liquidity through lending? And so that's a big theme. That's been the theme for a while now, but I would just say it's so much more prevalent. And it's not just one or two clients that we work with that think that way, but it's many now that I think have evolved to think along those lines. So, as they think about their overall balance sheet and how to best maximize their balance sheet and their own treasury management function, lending and repo are a huge part of that now and very strategic in nature for those discussions.
And would you say that from a lender type perspective, is that just U.S. pensions? So CAD pensions in there too, who have that same similar focus?
Yeah, I mean, Canadian pensions might also do a lot of additional trades, and they might have an even broader remit in terms of how they think about these topics. But yeah, I wouldn't probably even be specific to just North American pensions. I think that it also has more of a global theme too for some. But I think the US and the Canadian pensions are definitely in these categories. Some other pensions globally might be more cash rich, where they just generally are generating more cash. And so it's a different conversation. They have different constraints. So
Sounds like that's a trade. One guy long cash, one guy looking for
yeah.
cash.
Yeah. Good thing you're clever and creative there, Jim.
Well, we need assistance from our client service team. What about 40 Act and investment managers? They're not
Yeah.
focused on raising cash for it.
No, I mean, some are around the edges, especially if they themselves are managing that cash directly in products and funds they would otherwise oversee. For some mutual funds, lending is maybe not to the extent that it might be for a pension, because what they can do with that cash might be more limited. So there's less ability to stretch. But yes, some mutual funds look at it that way from a cash raise perspective, but many are looking at it how they can best navigate intrinsic, whether that's opening up new markets, participation more broadly for their funds, or the big trend amongst pensions. How do they improve their own profile with the banks in terms of being a lender of first choice? As you both know, we've spent a lot of time in the last 12 months and most recently the last handful of months preparing to support clients for capital-friendly solutions that are a little bit differentiated from other trades and transactions or other structures. And so the more that we roll that out across other clients and the bank counterparts, I think the more advantageous some of our clients will become in terms of their ability to essentially mitigate RWA constraints for the banks. And so if we can essentially work with clients that want to be first in line when it comes to their RWA profile, they're likely to see more flow and more trade opportunity. Mutual funds being the most challenged amongst others.
Can I ask
Back on trust.
one last client type? So insurance companies, I know we do business with a few of them. Would you
Yep.
describe them as engaged and sophisticated, but as focused on additional trade types and structures as would be global pensions, or in a different category based on constrictions maybe that are unique to an insurance company?
Yeah, I think insurance companies, not all, but some, and some are very sophisticated in this product space, are going to be very interested in a lot of equivalent trade types that some of the pensions might be interested in. I think the difference is just the asset base that they're naturally long is not going to be as broad as pensions might be. Their focus is going to be more in the lane of which their lendable sits in. And you guys are obviously familiar with that, being the ones trading the books. I also think that there's a lot of natural, like I know you were just giving me a hard time about matching up client types, who maybe faces off to whom in terms of peer-to-peer, but insurance companies, some of them are great peer counterparts to some of our pensions. There's a lot of natural trade opportunities that come from that. We've definitely had some success there, and hopefully we'll have a lot more as we grow our book of peer-to-peer across our client base.
Thank you.
Let's talk about the near term. So we have quarter end coming up soon, the week after next. We have a major industry conference, ISLA Americas, in sunny Miami, Florida, coming up in probably 3 or so weeks, the week of the 13th of October. Mark, you're going to be down there. What's the feel for that conference? Are you already arranging your calendar?
Of course. Looking forward to it. I think in the past, you've complimented attending conferences with me as opposed to someone else's willingness to make introductions. I'm looking forward to it. Last year was canceled.
Yes.
I think it's good for us to get together and see all our partners in one place. Very much looking forward to it. How about you?
I am very excited for that conference. I'm there for the full time. So if you want to find me, you'll know where to find me. I have it from good authority that they have already surpassed their greatest attendance number to date. It's going to be a very well attended event. They have more sponsors than they've ever had, more participation across exhibitors. I think it's going to be a really great conference, pretty diverse attendee list. And the thing that is exciting for us and where our focus lies in the industry with the beneficial owners is that for the first time, ISLA Americas is partnering with the GPFA to host a closed-door beneficial owner focus session on Tuesday morning before the conference starts. And the reason why I think that's great is it gives that lender participant community an additional reason to attend over and above the market education and market connectivity that otherwise occurs. I think there are more participants coming this year because of that on the beneficial owner lender side. I think from here, that'll only grow further. Just like ISLA had success with that sort of engagement the last 5 years, more than the last few, they've done something similar where they've partnered to host a beneficial owner focused meeting. It grew quite significantly this past year. They probably had nearly 50 people in a room. I think it's a great sign for the industry, for the event, for ISLA Americas, and I'm really pleased to see that level of engagement from another area of our marketplace. Jim, you'll be in Asia that week, right?
Hong Kong and Singapore, doing some broker visits.
Okay. Hopefully working hard for the money.
We are. Yep.
Okay. All right. Well, Mark, thank you. Jim, thank you. I'm really glad you're both doing well. I'm glad we focused on your health and wellness in this podcast and upcoming plans. And thank you for potting. We'll pot again soon. And listeners, we'll be in touch. Thank you all.
Thank you, listeners.
Bye, everyone.
Thanks for listening. And now for our disclaimer.
This material is for your private information and does not constitute legal, tax, or investment advice. There is no representation or warranty as to the current accuracy of or liability for decisions based on such information.